Okay, at the top of the hour, the Treasury auctioned off $24 billion worth of 10-year notes, which actually yielded a whole lot stronger demand than anticipated. Now, normally an auction like this is considered business as usual, but today's offering, according to a lot of analysts, takes on a special significance. Bond markets now sold off for 7 consecutive days as investors grow more fearful that inflation is rearing its ugly head, a concern apparently not echoed by Fed Chairman Ben Bernanke in his Capitol Hill testimony earlier today. For more on the message in the bond market and what it means for your investments, we're joined by Peter Schiff, President, Chief Global Strategist, Euro Pacific Capital. Welcome back to the show, Peter. Great to see you. So I know you've been very critical of Bernanke. What was your reaction when you heard he'd consider ditching the rest of the QE2?
Yeah, well, first, I was watching his testimony, and it was very easy to tell when he was lying because his lips were moving. But when he is going to deny, one of the congressmen asked him if he was concerned, that the fact that the Fed was now the largest holder of treasuries, eclipsing China, if he was concerned that his involvement might be distorting the bond market, Ben Bernanke said, oh, no, we're taking great pains not to distort the bond market. Well, that's a lie. He's deliberately distorting the market. That's his goal. He is trying to make interest rates be lower than they would be if the Fed was not distorting the market.
But and Peter, the bond market's speaking out on its own, right? Are the bond vigilantes, would you use that phrase yet, coming in? Because some people think that the bond market's moving faster and well, which is a little bit unusual to be this far ahead of the Fed, right? The Fed funds futures not pricing in an increase until the end of the year.
Well, he is closing his eyes to remain blind to inflation. Bond prices are rising precisely because the Fed is creating inflation. He wants to pretend that interest rates are rising because the economy is improving. That's not the case. In fact, he's trying to pretend that the reason there's inflation in emerging markets is because, according to Ben Bernanke, that's where the growth is. Well, economic growth doesn't cause prices to rise. Money supply growth does. And the reason that prices are rising so rapidly, or money supply is growing so rapidly in emerging markets, is because of what Ben Bernanke is doing over here. We are the issue of the world's reserve currency. And when we print money, we're forcing those other countries to buy up our money by printing their own.
So
and, he even had the gall.
To me. Explain this. Sorry to interrupt you. I'm curious. The yield curve, right? Bernanke mentioned this today. It is as steep as it's been in a whole long time. So why in previous cycles that's been significant, that we're in the early stage, the nascent stage of a strong economic recovery. So why is it different now?
Well, or inflation. In fact, if you look at where the 30-year yield is right now, it's about where it was on average between 2001 and 2007, when we had 4 or 5% unemployment. So if 30-year interest rates are the same today as they were when unemployment was less than half of what it was now, I don't think rates are rising because the economy is so much stronger than it was in 2002 or 2003 or 2004. I think it's because there's a lot more inflation in the pipeline and because there's such a huge supply of government bonds. And, Ben Bernanke actually stated, and you go play the tape, he said that even if you just look at food and energy, that food and energy prices are only rising by 1% a year. Now, I don't know where the Fed chairman buys his groceries or his gasoline, but prices are rising much faster than 1% a year. And he sheds whatever credibility he had left if he says that. And, if he's basically telling emerging markets the equivalent of let them eat cake, Marie Antoinette, when he's saying, hey, if they don't want inflation, then they better dump the dollar. They better not have the dollar as a reserve currency.
But can
he's basically abdicating the dollar's role.
Can the Fed tighten policy and continue job growth? Because he points out the reason, right, his argument is you've got slack in the economy, unemployment, but there's still wage growth.
Well, but we're not going to create jobs by creating inflation and debasing the dollar. We're ultimately going to destroy jobs. Yes, it is true, if the Federal Reserve did the right thing and raised interest rates, we would have an economic contraction. Some people would lose their jobs, but those jobs have to be lost. We have to restructure this economy on a sustainable foundation. We need more savings, we need more investment, and we're not going to get that with 0% interest rates. We're not going to get that if we're flooding the world with money and Americans are going around spending it,
and that's why
buying
you like
things
gold,
they can't afford.
Right? Gold, gold, gold. Peter's shtick, right? You love gold. Gold prices going up still, right? How high?
Well, gold prices are the way you protect yourself from what Ben Bernanke is doing. If you have a Fed chairman that's deliberately debasing our money and lying about the consequences, you protect yourself by owning gold.
What's more fun than a conversation with Peter Schiff on a Wednesday?
Paying attention to what I say and
you do. It's great stuff. It's a lot of fun and very informative. Peter, thanks as always.
Thanks, Laura.
2 huge gold coins over his right shoulder too. Some indication.
I got one too.
All right, you stole it from.
I did.